This conference will now be recorded.
Once the income statement budget is prepared, we can move on to the balance sheet budget, but you do have to have the income statement budget completed because there are a lot of parts that go from the income statement into the balance sheet budgets. So the balance sheet budgets are going to be primarily dealing with cash. Cash is going to be the main item that's coming and going most. And then the rest of the items, not nearly as much, especially the long-term assets, things like equipment and accumulated depreciation and our owner's equity items aren't going to really change. And so I will just provide those numbers, but it's our moving numbers that are going to change, like accounts receivable and accounts payable, our short-term items. Okay, so for the with the cash budget, we're going to have 3 different types of just cash budgets to look at where cash is coming and going from. From sales, how much cash are we expecting to come in, and when are we expecting it to come in? Because not all of our cash comes in at the time of sale. Some of it is on account. Payments the same way. We have 3 different types of payments that we could be making to materials, to our labor, and to any other various vendors that we're going to provide other overhead items. And then finally, the financing piece. This is dealing with dividends, paying out dividends, paying back loans, or taking out loans. So we're going to have 3 of those, and then we're going to come down and do a accounts receivable, and we're going to look at accounts payable. How much, when do we expect those to be paid? And that'll all show up in our balance sheet. All right, so our first budget here is cash collections. Cash collections, what we have to look back all the way to the income statement in order to be able to determine how much collections should be coming in. I give us some guidelines here, and in this first lecture example, it's going to be a fairly simple one, in that all of the cash collections are going to be collected within the current month or the following month. Now later on in future examples, we're going to add an additional month or more, because not always do our account receivables get paid or collected within just 1 month. But this time, that's what we're going to do. We're going to say 70% of all the sales are collected in the current month. And then 30% of our sales are in the following month. And then I tell us something we have to know is, well, what is our opening balance for the account receivable? So what I've done is I've provided you with a little kind of grid, and we're going to use the same type of grid for the cash collections and then also the cash payments. So once you've done one, the other ones are going to fall very similarly, and you should be able to do those without a problem. So our AR beginning balance, of course, there's no sales with our beginning balance, but it's showing that, and remember, I tell us that everything else is collected in the second month. So of all the sales, these were the amounts that were left over from last month. And then therefore, I expect them to be collected in the current month, month 1, right now. As we move down, our first month, this month, we had 64,000 in sales, and we get that way back up in our sales budget. Let's see, it was here. On our sales budget, we expect to collect 64,000 in total sales. So I use that number then to determine how much of that 64,000 am I going to be bringing in cash right now versus how much is going to be coming in later. And this is also going to help to make sure I have enough money on hand to pay my workers and to pay my bills. So that's the whole reason we do these budgets. Do we have the resources available? So if I take 70% of this amount, the 64,000, I'm estimating that we're going to collect $44,800 out of this 64. And then we're going to collect all of last month's remaining balances, because I tell us that the rest of any sales are collected in the following month. The rest of the 70% is collected the following. So in total, in month 1, we're going to add these 2 up. In just a second, you'll see that. and we're going to have our total amount that we expect to come in cash-wise. Now over here, what I've done is whatever is left, or just taking 30%. 30% of 64,000 says this much of the 64 I expect to collect in month 2. In month 2, I expect to collect 19,200. So if we go down to, and let's do one more month, and we're not expecting any changes in our sales, let's assume. So we're assuming next month's sales, we're going to estimate the same amount, so 64,000. So in the current month, I don't expect to collect anything, of course, because in month 1, right now, I don't expect to collect any of next month's sales. That doesn't make much sense unless people prepaid. So in the second month, I expect to collect 70% again, which is the same number as over here, 70% of that month's sales in the second month. So then we can just do the total. In month 1, I expect to bring in current sales of 44,800 and our previous month's sales, the additional 17,000 from the prior month. So total, I expect to bring in $61,800. And then in month 2, what I expect to bring in. These are going to become important when we get down to our final cash overall balance to see what is our cash balance, because we're going to have cash coming and going, and so we need to have a good estimate of what our cash balance is. Do we have enough money to pay for items? All right, let's do the same thing for the payments of direct materials. So I tell us that anytime we, any month that we need direct materials, we're going to pay 40% of whatever the cost is currently, and then the rest of it we're going to pay the next month. We're going to pay it off. And then I tell us that we have an opening balance of $5,200. So that's why I put that here, because we're going to pay the rest of that off in this current month because it's from last month's accounts payable. So what I would like you to do is to try this. Go ahead and pause the video and fill out the next couple lines, and then let's compare it to what my answers are. So go ahead and pause now, and then I'll start back up here in a few seconds. Okay, for month 1, we need to look up how much in purchases did I actually need for direct materials. So I need to go back to my income statement budget. So my income statement budget for materials, remember what came up here, here's my direct materials budget. I scrolled down, and when I added everything up, all of my cloth, I determined how much it cost per foot. I needed to buy $5,152 of cloth. And then remember, I'm paying 40% of that now, 60% next month. So that's how I want to set this up. 40% of 5152 is the 2,061. I'm going to be paying that now. In addition, I'm going to be paying last month's outstanding bill. I'm going to pay that all off as well. And then whatever's left, or taking it by 60%, either way you want to do it, whatever's left of the 5152 after I make my current payments, that's how much I'm still going to be owing next month that I'm going to pay off. So if I show next month what it's going to look like, assuming I have the same amount of sales, remember everything revolves around sales. If my sales go up, then everything else is going to change. All my different schedules, I'm going to have to buy more or less materials, and I'm going to have more or less workers perhaps. Okay, so for the second month, 5152 again, 40% is what's going to be paid off in month 2. I don't pay off anything early. I'm not prepaying anything. I'm paying it as I buy it. So in total, I expect to spend $7,261 in month 1 because I had a higher remaining balance in the previous month. That's why this number is going to be higher than in month 2. Month 2, it's going to be a little bit lower balance because I have less to pay off from the previous month. Okay, so that tells us how much cash we should expect to pay for materials. Now we need to do the same thing for labor. So going back up to the income statement budget, we need to look up how much do I expect to pay in direct labor. And then I tell us of whatever I expect to pay, I pay 75% this month, 25% next month. And then I give us our opening balance. How much do we owe from the prior month? And we owe $77.50. So what I'd like you to do again is at this time pause, and then in a few seconds, we'll see if you got the right answers. Go ahead and fill this out now. All right, so we go back up and to our direct labor. Here's our direct labor budget, and we had worked it all the way through. And you can see how these numbers are needed. We had to do the income statement first to be able to get to these balance sheet budget items. I expect to pay $30,590 in wages that are going to be earned for this month. So $30,590, I need to bring this down now to my direct labor budget. $30,590, take 75% of that. And that's this $22,942 is what I'm going to be paying on current wages. And then of course I'm going to be paying off last month's wages right away. Whatever's left out of that 22,000 out of the full 30 is what's going to go into my new wages payable, which is pretty similar this time to my old wages payable. So there's not going to be much of a difference between month to month how much wages I expect to pay, as long as I don't hire anybody new or let anybody go. So in month one, I expect to pay a total of $30,692. Now, when we get to the factory overhead, you very well could have a budget for this one in addition, but in my examples here, and in most of our other examples that we're going to do in class, we're going to assume that all of our factory overhead budgets are, any expenses in those are going to be paid off in the current month. And that would be anything excluding depreciation. So anything that goes on our, and we're gonna see those in just a little bit, but there's no real reason to make a separate budget for these if I pay them 100% right now. So all factory overhead items, let's go up and see our factory overhead on our, we got it right here. Here's our factory overhead budget. And how much I expect to pay. I expect to pay $16,885. Well, almost all of that will be paid. Notice you definitely have to pay for materials, and you have to pay for that extra labor and the utilities. The only thing you never pay for is depreciation. As you should know from Accounting 101, depreciation is just the use of the asset, expensing it out. So there is no payment. So we're actually going to be paying $16,885 minus the depreciation amount of $500. And we're going to pay all of that in the current month. But we'll see how that looks here in just a few minutes. All right, so now we have everything we need, or almost, we have all the separate budgets we need. Now we're going to put it all together to figure out how much cash do I actually have on hand. And then there's a few other items that need to be known. So things that are other, remember the financing piece, because if we go back up here, there were three types of the receipts we looked at, payments we looked at. We looked at the three different payments: materials, labor, and the factory overhead. And then the financing, those are going to be the extra, the final things that I'm going to have to give to you. Okay, so I have to tell us, of course, what are we starting with in cash? We expect to pay some dividends. That's part of the financing. We plan on buying some more equipment. This isn't anything that's going to go on the income statement if we plan on buying it. If we buy it, how are we going to pay for it? Are we going to pay it off now or later? And I tell us that we're going to pay it off half in the month that it's purchased and then half in the following month. And then when I purchase those machines, I expect to sell some of the old ones for not a whole lot, but I'm going to collect all that money in the second month, so that's going to become important. And then finally, of the income taxes, I can't forget about those. Those are on the income statement as well. The income taxes have to be paid, and I expect to pay all of those in the current month. All right, so let's go through this cash budget. First thing we need to do is figure out how much cash is coming in. Do I have? And then we're going to subtract out all of the payments. So I tell us up here in A, we started off with $23,000. And then how much am I expecting to collect? Well, I can look from my collections from customers up to my budget above. My budget above in month 1, actually we're doing this for, I believe it's the second month. Well, when we do the balance sheet, we'll see that in a second. But in month 1, I need to just do it month by month. In month 1, I expect to collect $61,800. So the $61,000 comes here as an expected cash collection. And then the collection from our sale of assets, well, that doesn't happen until the second month. So there's nothing going on here. So total available cash before I start spending is $84,800. But now I have to start spending money. And we're going to do them in the order of our budgets above. So the first budget was our direct materials for cash payments, and I expect it to pay in the first month $72.61. So I'm going to list that as $72.61 here. And then my labor budget. My labor budget was the $30,692 for month 1. And then factory overhead. Remember, we went through this. This was the $16,885. Let's go back up. $16,885 in total overhead, and I'm subtracting out the $500 of depreciation because we don't pay for that. That's not a payment item. So I'm expecting to pay $13,385. And there we go. Selling and admin expenses. I tell us that up above in the factory overhead budget that we expect to pay all of our selling and admin expenses as well. So that comes directly from the income statement. So the income statement told us when after we did added all of these things up, our less selling and admin, and that includes $200 of depreciation. So I want to take that back out. I don't want to use the full $9,300 because when you add up all of these, it's $9,300, all 5 of these. But I don't want to include the depreciation because no payment goes for that. So I expect to pay $9,100 in sales and admin expenses. So I want to include that $9,100 here. I don't purchase any new assets yet. That goes in the second month. I do expect to pay a dividend in the first month of $10,000 to my stockholders, or if it's my own business, to myself. And then finally, I need to look at the income statement for the income tax expense. The income tax expense is right here, the $26.56. I expect to pay all of that in the current month. So when I total up everything now, my cash brought in minus how much cash I'm spending, my cash balance does change quite a bit. It went from $23,000 now down to $87.05. This is going to be an important number for me to use in my final summary balance sheet budget. I need to know what my cash is. All right, so that takes us to our what I would like for you to do is let's go ahead and fill out, before we do the balance sheet budget, the last piece. I want you to fill out month 2. Now month 2 is going to see the $87.05. That's going to be our beginning cash for month 2. What we ended with in month 1, it should make sense. That's what we're going to start with in month 2. Now, going through the same steps as we just did, looking back up at the previous budgets when needed, go ahead and fill out month 2 and let's see how you do. So pause the video now, and in a few seconds, we'll look at the answers. Okay, so for month 2, looking back up to my cash collection budget, in month 2, I expect to collect $64,000 in sales from last month and this month. And then I tell us in this C part 2 here that I am going to sell some of my older machines, and I'm collecting $750, so that's more of a cash collection. So total, I'm bringing in $73,455 with my beginning cash. Now separate out, let's do our first 3 budgets from above. So the first 2, you should have, they're not always, of course they're not going to be the same as the first month, because we have different accounts payable and account receivables from the prior month. So in month 2, the 5152, let's see where we got that. The 5152 came from right here in our cash payments for materials. In the second month, I expect to pay out the current month's amount plus last month's that I didn't pay off, that 60%. So that 5152 that needs to show up as a payment. $30,590 is pretty similar to what it was the prior month. Factory overhead, when I pay all of it off, there is nothing to pay off in the previous month, and nothing was stated that anything changes from month to month. Our sales didn't change, so therefore our variable fixed costs aren't going to change, and of course our variable factory overhead costs aren't going to change. Of course, our fixed costs aren't going to change either. So it's still the same $16,385. Same selling and admin, nothing was noted that anything changed from month 1 to month 2, still taking out the depreciation. I tell us up here that I'm purchasing $5,000 in assets. Half of it I'm paying off now, half next month. So I'm going to show a $2,500 payment. And then I've got my income tax expense, same as the last month I expect to pay. So giving me a total balance, it still went down, but not nearly as much as it did the prior month. A lot of that happened to be because of the dividends were paid in the prior month. But still, we're going down, so that is something I would have to keep watch on pretty soon. If that keeps at this rate, I'm going to be down to nothing, and I'm going to have to borrow money or pay less on my bills now and put more into the future, which you don't want to do. Or not buy any new assets perhaps, or pay less on those assets and have it go to the future. Again, you don't want to necessarily have to do that. Perhaps one thing I could do is put some of my factory overhead on account, pay that off later. Again, all things you don't necessarily want to do, but you may have to just to keep a cash balance. All right, our final piece. We're going to need these numbers to know what our cash balance is when we do the balance sheet. And here are the 4 items that you're going to need to do the balance sheet. All the rest of the balance sheet items you can get from our above budgets, whether it's on the income statement or the balance sheet budgets. We're going to use both. All right, I tell us in this example that we're going to do the end of the second month. That's going to be the numbers that I want to use. So I start out then, whenever you have a balance sheet, you always start with cash. Our ending second month balance was $7,071. So that's what I'm going to list as my ending cash balance. Now, if you remember much of what a balance sheet looks like, the next thing that comes up is your accounts receivable. And I'll go ahead and show the whole current assets here. And then we have our inventory, but let's do it one at a time. Our accounts receivable. You got to think, where would I be able to look? What kind of budget would I look at to see how much in receivables do I expect to still come in that haven't been paid yet? Well, hopefully you'd want to look at your cash receipts budget. So in the second month, I had 64,000 in sales. All of the prior month's AR was paid off, so none of that got carried forward. But out of the 44,000, or out of the 64,000, only 44,800 was received this month. So that tells me that 19,200 would have been carried over into month 3 as a receivable. So my account receivable, it happens to be the same as this one just because everything is paid off in the next month. It won't always be like that when we get to more difficult examples. So I want you to be able to see how I got our current AR. Basically, what I did is I took our sales minus how much we have coming in, and then how much of the previous AR is still left. And in this case, there's nothing still left because it's all paid off. So 19,200 is our AR balance. Okay, next thing I can look at, and you could have put these in any order, so I normally would have done raw materials first. I'm not really sure why I did it this way, but that's okay. We can do finished goods first. So with our inventory, we're going to have 2 different types of inventory. Items that are complete, and then our items, and we could actually have 3. We could have work in progress items, which is getting a little bit more in depth than we don't really need to do that right now. But probably we would have one of those, a work in progress balance. And then we would have our beginning raw material balance. How much in materials do I still have on hand? All of that goes to our balance sheet. All right, so our finished goods. Let's look at how I got these numbers. I'm telling us, what does this actually mean? Let's see. 250 items at 2013. Let's go back and see if those numbers ring a bell. 215 items at $20.13. Okay, so let's go back up to, here we go, our materials. Here's our materials, but really what I want to do is with finished goods, I want to see how many items do I have on hand at the end of the month. And so let's keep going up. Here we go. Here's our production budget. In our production budget of the polo shirts, finished product, so I expect to sell 1,000 finished product, but in my ending inventory, I expect to have 250 items remaining. That would be done, completed. Okay, that's good to know, 250 items, but how much does each item cost me per polo shirt? Well, that's where I come down to my cost of goods sold. And I need to determine how much did my polo shirt cost for one item? And it cost $20.13. So if I have 250 of those polo shirts at $20.13, that's how I get this very first number as part of my finished goods inventory. So what I want you to do then is go ahead and pause and do the other 2 items. How much in finished goods do I have for the pants and for the t-shirts? Add all 3 together and come up with your final finished goods ending inventory. All right, so our finished goods ending inventory, you should have had 125 pants that are going to be in ending inventory, we expect, costing $19.63 each, plus 500 t-shirts costing $7.95 each. So when you add up all 3 of these, I expect $11,461 in total finished goods ending inventory. Now in my beginning raw materials inventory, we're going to do the same type of thing. This one's a little easier though. It's all in one budget instead of looking at 2 different things. So I come to my materials. Oh, not far enough up. Let's go to my direct materials on the income statement. Here we go. Direct materials, I expect in cloth A I expect to have 250 feet of material left over, and it costs 50 cents a foot. So 250 times 50 cents would be a 125. And then 500 feet of material B in my ending inventory at 30 cents a foot. So that's all stuff that I still own that I need to keep track of. And I would have this in maybe some T account if I was doing this all as one huge project and doing the journal entries and T accounts. So I come down here and let's add those two together into my finished goods. Not my finished goods, but my raw materials. 250 feet of material A at 50 cents a piece, 50 cents a foot. 500 feet of material B at 30 cents a foot. Add those two together and you get $275 of materials. So total current assets, the $38,007 when you add up all of these. I give us our long-term assets, how much in equipment we have. So now we're going to tack those on separately. Leaves us with total assets of the $46,007.25. Now we're ready for the liabilities. The liabilities, we're going to have accounts payable for any of our materials because we have a budget for that. We're going to have a wages payable for the unpaid wages that are still out remaining. And then essentially, we're just going to have our stock and our retained earnings left because all of the other items are paid on time and they're not extended into another month, so there's nothing due. So let's go through those. Let's start with our liabilities. Liabilities, I show $3,091. Let's go up and see where that came from in our direct materials budget. Okay, so in month one, whoops, I want to come down here to month two because remember we're doing the second month. In month two, I expect to purchase $5,152 of materials. However, I'm only paying for 40% of that now, or whatever the percentage was. I think it was 40, but it may have been, yeah, 40%. The remaining 60% is going to be paid next month. So that's a bill that I owe. I need to show that as a liability. So in going into month three, I still owe $3,091, which happens to be the same amount that I owed from in month two that I owed from month one, or that I paid in month two that I owed from month one. It's gonna pretty much go in a diagonal from here on out. What I mean is this $3,091 is going to be paid off in the next month, and our third month of sales collected will be another $2,061. So our accounts payable then is the $5,152 in purchases minus what I've already paid. Whatever's left is what I still owe, the $3,091. Go ahead and do the same thing now for the wages payable. See what you get for wages payable still due or going to be due come in the beginning of the month three. Okay, what you should have calculated was the $7,647, how much labor payment we still have remaining. Those are our only two items that I actually owe money on. I don't have any other notes that I need to pay anything else. There was no other opening balances that says I have anything else to pay on. And so all I need to do remaining, if I don't have any non-current liabilities, I simply need to add in now my two owner's equity items, common stock and retained earnings. So those I have to give to us. When we add them up, our owner's equity is $35,000, adding in our liabilities of the $10,739. Notice what happens when we add up our total liabilities and owner's equity. It does match our assets. So this was a very long process to go from the sales budget all the way to here, but everything works out beautifully. All right, we're going to end there. and I will see you in class.